Hello, I'm Kevin Reid and welcome to this Tolley seminar on change of accounting date issues related to the switch to tax year basis of assessment for unincorporated businesses and LLPs. This is going to be one of two lectures. On this first one I'm going to talk in reasonably general terms about what the key issues are, and in the second lecture I'll look at things in more detail by using a sort of mini case study of someone who's looking to change their accounting date and also look at the impact on capital allowances and such like as well. So just to give you an overview of what we'll be covering in this lecture, I'll give you a very brief reminder of the coming changes. I'm not going to go into all the detail that's been announced, and also we'll look at the importance of when you actually change your accounting date and remind you about that. In particular, most people are going to want to do it in the transition year, but we'll discuss why. We'll discuss the different options that you have in terms of preparing a long period of account or two separate periods of accounts, and what the knock-on impacts will be, in particular how those rules would interact with what the transition rules are in the Finance Act 2022. So let me just give you a quick reminder of one or two of the key points about the new tax year basis of assessment before we get into the details of this lecture. Remember that for most unincorporated businesses, they're going to want to change their accounting date to tie in with a tax year before you get to 24-25. And also worth reminding you that the legislation does allow you to treat the 31st of March as if it is a 5th of April. So some people will prefer to keep their accounts to a calendar month. If you don't change your accounting date before the year when the new rules come in, then it's going to mean that all future tax returns that you do are going to require some apportionment of profits across two different accounting periods. Obviously that's likely to involve estimated figures with subsequent amendments, and in fact there's a consultation going on at the moment, as you may know, about some easements they might make to deal with those sort of issues. Now, although most businesses will want to change their accounting date, it's worth mentioning that some won't. First of all, particularly seasonal businesses, it may not be convenient to have a change of accounting date at the end of a tax year. But also partnerships. A lot of smaller practitioners I know have clients who are partners in large professional firms like architects and law firms, etc., as well as accountancy firms. And those decisions about changing accounting date are going to be made at partnership level, and therefore for those sort of clients, in most cases, changing an accounting date isn't going to be an option for you, and you are going to have to deal with this ongoing apportioning. And that's going to be particularly relevant when you've got partnerships that trade internationally, where they tend to like to have a December year end, which usually ties in with other jurisdictions. Now, going back to those who are going to make a change of accounting date, it's important to realise the difference between doing it in the transition year, which is 2023-24, and doing it before the transition year, which would be 2022-23, the tax year that's recently begun. If you do change your accounting date in the transition year, then the extra profits that are assessable in that year, because you've added in extra months worth of basis periods, are, once you've deducted any overlap profits that are being carried forward, going to be regarded as transition profits. And a reminder that transition profits, the taxation of them for income tax purposes is automatically being spread over 5 years, commencing in the transition year of 2023-24. And remember, there is an option to elect out of that if you want to advance the taxation of some of those profits. For instance, if you have a year where your profits are otherwise quite low, you may want to bring in more of them, for instance, to use up your basic rate band. And the other thing to remember about transition profits is they are excluded from the definition of adjusted net income, which impacts on things like personal allowance abatement and also whether any high income child benefit charge would be payable. Final thing to mention to you as regards transition profits is that they are also excluded when you consider averaging of profits, and there are different rules these days for farmers and market gardeners compared to creative artists, but any transition profits you have will be left out of the averaging process. Now, that was all if you change your accounting date in the transition year. If you choose to change it in an earlier year, like the current year, then any additional profits after deduction of overlap profits are going to be fully chargeable in that year, and they will also form part of your adjusted net income, so potentially will impact on personal allowance, abatement and high income child benefit charge. So it means that although you do need to consider it on a case by case basis, it's pretty clear that in the vast majority of cases it's going to be better to change your accounting date in the transition year to take account of the rules for transition profits, where you can have the spreading applying and that they won't affect your adjusted net income. Clearly, having extra profits coming in later years is obviously going to be good from a cash flow perspective as well. Now, the main thing I want to talk about in this lecture, having remind you of some of that background, is just about the actual basis period issues when you are changing your accounting date, assuming you are doing it in the transition year. Under the existing current year basis rules, supposing you currently have a 31st of December year end, if you change your accounting date from, say, the 31st December to the 31st of March, you'll have two ways of doing it. You could either do a long period of account for the 15-month period, or you could prepare two separate sets of accounts, one for the normal year end to the 31st of December, and then a separate short accounting period for the 3 months to the 31st of March. If you were going to do the former, i.e. the long period of account, how that's dealt with for tax purposes would mean time apportioning the 15-month period's profits after capital allowances into 12 months profits and 3 months profits using a day count basis. And that's different to if you've got two separate sets of accounts, clearly, where the results could be very different compared to time apportioning a long period. So it's important to appreciate that those two methods do produce rather different results. And the other thing that's inherent in that is if you prepare two separate sets of accounts, then there'd be no time apportioning at all, and any capital expenditure that you might have would be allocated to the particular period in which the expenditure is incurred. Those are the rules under the existing current year basis rules, which is what you would be having to deal with if you change your accounting date before the new system comes in. But it's important to think about how they might interact with the transition year rules if you are doing a change of accounting date in the transition year. There seems to be nothing in the transition year provisions that are in Schedule 1 of Finance Act 2022 to prevent you having that same choice of either preparing one long period of account or two separate periods of account, whichever might be more beneficial to you. And remember that if two separate sets of accounts are prepared and expenditure on plant is included in the 12-month period, then the capital allowances will be given in that 12-month period. If you assume that it's plant machinery that's covered by annual investment allowance, those capital allowances will be given in the 12-month period, and they will reduce profits that are not eligible for spreading, which is obviously going to be good news. And they will also be reducing your adjusted net income, which obviously may save you having your personal allowance abated, or perhaps save you being subject to the high income child benefit charge. It's also worth reminding you at this stage that although we've been saying businesses have got that choice of doing two periods of account or one long period of account, that won't be the case if you've got an accounting date currently early in a tax year, like a year end April, May, June, because under section 217 subsection 3 of ITOIA, periods of account exceeding 18 months are not recognised as a change in accounting date for tax purposes. So it would appear that if you've got, say, an April year end at the moment and you want to change it to a March year end, you're not going to have the option of preparing one long period of account. It would have to be a 12-month set of accounts and then another 11-month set of accounts. It would perhaps be useful to have some clarification on that from the revenue, and perhaps they might even consider some sort of easement, considering that section 217 restriction, so that those who currently have an April year end would have as much flexibility in dealing with the change to tax year basis as those who, for instance, have a December or a January year end, but we haven't heard anything like that yet. And I'll just leave you with a planning point from this lecture, and it's really, 24-25 still seems quite a long way off. It doesn't start until almost 2 years off. But in fact, if you're dealing with a business that's got an April year end, the basis period for the transition year has already started. It began on the 1st of May 2022. So these issues about whether, when and how you might change your accounting date, really need to be being discussed with clients now. And from my experience in lecturing on this topic over recent months, be prepared for lots of questions, because the rules are quite complex, and clients may need a lot of explanation as to why they need to change their accounting date, why they should consider timing capital expenditure at particular dates rather than others, etc. So good luck with dealing with all that. I've been Kevin Reid, and in the follow-up lecture we'll look at it with a sort of practical example for you.